objective 1 and learning objective 2. 1, become familiar with the different types and forms of business organizations and how those business organizations use accounting information. And then we're going to talk about the 3 principal types of business activities. That's all we're going to do today, get a good understanding of that. Next class, we'll get into the financial statements and how to prepare, and we spend a lot of time in that area. Okay, identify the forms of business. Well, actually, there are 3 forms of business. First of all, there is the sole proprietor. Anybody know who that guy would be, or link? Give me an example. One person. What kind of business would they be running?
Like restaurant.
Restaurant, maybe?
Home business.
Hey?
Home business.
Yeah? I just passed a little convenience store down here. Probably one guy owns that. Okay? And that's the business. It's really simple to set up. Very simple. I'm in business. That's it. I don't have to tell the government anything. I don't have to register. I'm in business. And I'm the only owner. Okay? And there are some tax advantages for that, because if there are profits in the business, then I pay taxes. But the revenue, the money that comes into the business is my money. And what I buy in the form of equipment or anything, that's my equipment. Because there's no difference between the business and the owner. They're the same. They're absolutely the same. So that's why it's so simple. But the problem is, if you go bankrupt, you know what I mean bankrupt?
Yeah.
If you can't pay your bills, if this corner store down here, I should have got the name of it when I came through. If that person can't pay the business and he owes people money, the people can go after him, can take his house, can take his car, can take anything he owns. Of course, he owns what's inside that business. They'll take that. But if that's not enough, they can take anything, everything. Because there's no difference between the owner and the business itself. That's a sole proprietor. A partnership. You know what a partnership is?
2 to 3 people.
2 people, yeah, I think of lawyers or accountants, what have you. Now you have 2 people who come together and form a business. But again, the same thing happens. The advantage of having 2 people is this person has money and this person has money.
They can go.
And they put them together. Right. Okay, so this person has skills that I need. And so they come together. So partnerships bring that together. But again, there's no separation between the partnership and the partners. The money the partnership owns, the partners share. And they may have an agreement, 50-50, 60-40. Whatever they have agreed to.
Does this not increase?
One partner might put more money in, so he wants a bigger share, or she wants a bigger share. Whatever the agreement is, the 2 have come together. But again, whatever that business owns, vehicles, equipment, what have you, they belong to the partners. And if the business can't pay the bills, the people who owe money, and I'm using words that we will become more familiar with, but you understand when somebody owes you money, that they're going to come and they can take the things that are in that partnership, sell them, and see if that covers it. If it doesn't, Then they go after the partners. And they say to the partners, all right, I don't care what agreement you two have. You owe me money. And you two guys are partners. Okay? And I'm owed 100,000 by your business. Not for 50. I come after you for 100. Why? Because you've got what we call deep pockets. You know what deep pockets mean? Lots of flus. So I go after you. You go after your partner. I don't care. I get my money. That's what happens. There's been cases where two people owned a travel agency. And one started to have personal debts and problems and stuff like that. So he took a lot of money out of the partnership, bought a bunch of tickets, and took off. Well, the other partner had to pay for all of that. And then it's up to the other partner to go after his partner or her partner to get the money. So you see, a partnership, again, like a sole proprietor, is easy to establish. You're bringing together 2, 3, 4 more people, all of them, okay, have an agreement as to how they're going to share, and they pay taxes on the amount of money they make. Yes, so I mean, tax in this country. Now, how many people in here have a father who has a business? You? Yeah. And I would bet you that your father incorporated that business. Am I right?
Yeah.
Right. Many Emirati families are corporations. Now, a corporation is a different entity. Corporation, though, you have to inform the government. You have to approach the government and say, I want to form a corporation. I'm going to call it Al Shamsi Corporation or ABC Corporation, okay? And the government says, okay, pay us a couple thousand dirhams, and we will create a corporation for you in the name that you want. And then we will allow you to sell shares in that corporation to other people. All right. So now you are a corporation, and most businesses are corporations. And you will know that they are a corporation because in their name, they're going to say ABC Company, CO. Or they're going to say ABC LLC, Limited Liability Company. Or it's going to say ABC INC, Inc. Have you seen those names?
Yes.
They stand. Inc. is for incorporated. Co is for company. All right, LLC means Limited Liability Company. So if I do business with ABC Corporation, I lend them money or I supply them, and they don't pay me, I go after the corporation, but I cannot go after the owners of the corporation. They are protected by law. They're separate. In this case, the corporation is separate than from the individual. The corporation owns equipment. Corporation buys supplies. Corporation pays the debts. Corporation earns money. Then they pay taxes. If you're in America or Canada, then the corporation pays taxes, and then whatever's left over, they give to the people who own the corporation. Now, the people who own the corporation are called, do you know? Shareholders. Or they're sometimes called stockholders. Because if you own shares in a corporation, that's often referred to as stock. So if you own shares of a corporation, you are a stockholder. And that means you're entitled to a portion of the shares that the corporation has earned. Now, there are many advantages. That's the main advantage of a corporation. I can't lose my house. If I start a business and I incorporate it and the business fails, they can't come after me. They can only go after the corporation because the corporation is separate from me. Not like sole proprietor, not like partnership. Corporation, completely separate. It earns revenue, it pays expenses, it pays taxes. Okay? So one of the advantages too, it's easier to raise money. I sell shares. You want a share of my company? I'll give you 5% of my company, you give me 100,000 dirhams. So I raise money. That 100,000 dirhams goes to the company. Keep in mind, the company is a separate person. The company is raising the money. Okay? But the big thing is no personal liability. Any questions? No personal liability means that if my business fails, the people who are owed money can't come after me. Okay? Whereas if I was a sole proprietor, they can. I have what's called personal liability. And I told you last class that the reason you take an accounting is to learn the language. Now you're starting to learn, I'm having great difficulty now, trying to use words that you're not familiar with, that you would be familiar with. After this class, then I can say exactly assets, liability, stuff. I mean, you're gonna know. But fine, ask questions like that. Absolutely. Personal liability means that I would be personal for the debts. I'd be responsible to pay the debts of the company. I am a liability to pay it. So no personal liability means none. You can't touch me. Another big reason why many families are corporations is simply this. You're a sole proprietor or you're a partner, and what equipment or what have you that belongs in that business belongs to you as a partner or as a sole proprietor. If you die, that's it. That's the end of the business. The business is you, and you just died. That's the end of the business. Or we're partners, and you die. That's the end of our partnership. The business is finished. You see, you can't pass on anything from the business to anybody else. But if you were a corporation, you own shares or stock in that corporation, and I die, I transfer my shares. The business still keeps going, even though the owner has died. But if you're a sole proprietor, the business is finished the moment the person dies. If you're a partnership, the business is finished the moment one partner dies. You have to reestablish it again. But for a corporation, it's very easy to transfer ownership of whatever the business owns. So that is an overview. If you have any questions, let's go on and talk about. All right, get on the phone, put it on. You need the scan thing. There, scan it. All right. Okay, ready? Who's on? Come on, join. Mohammed Saeed. Mohammed Saeed, both for El Shamsi. He's on a place. Come on, everybody get in, 9 players, I want 16 players. Okay. Pretty good. We had 14, we just lost 2. All right, question number 1. A proprietorship form of a business organization must have at least 2 owners, generally receives favorable tax treatment relative to a corporation, is classified as a separate legal entity. Now, some of these questions, okay, wait a minute, no, more? You gotta be quick. No, the answer here is that a proprietorship has favorable taxes. Now, taxes are just starting to come into this country, but Canada, if you are a sole proprietor, then you pay taxes on profits the company made. But if you're a corporation, the corporation pays taxes, and then when you get the money, you have to pay taxes. So it's like double taxation. All right? So a sole proprietor is not a separate legal entity. A corporation, and I know I'm talking words you're not, is a separate from the owners, legal entity. Entity means an individual. You're an entity, you're an entity, you're an entity, you're an entity. A corporation is a living, breathing taxpayer in the eyes of the law. It's a legal, separate legal entity. Do you understand those words? Okay. So there's no shame in getting that one wrong, but generally receives favorable tax, yeah. All right, question 2. A business organized as a corporation is not a separate legal entity, requires that shareholders, they call them stockholders, to be personally liable for the debts, or is owned by its stockholders or shareholders. Yeah, it's owned by the shareholders. It says not a separate legal entity. Yes, it is a separate legal entity. A corporation requires that stockholders be personally liable. No, that's what a separate legal entity means. The people who own the business are not required to pay the debts of the business. Okay? Capiche? Old Latin, and understand? All right. Well, what happened? Organized as a separate legal entity is, come on, everybody should get this one now. So you must become familiar with these terms. Question? Oops. Right, corporation, not a proprietorship, not a partnership. All right, now, accounting. When we're looking at companies, they all require accounting information, and they do it for different reasons. We have in a corporation internal users of accounting information. Now we have external users of accounting information. Now the internal users is management. They need to know, the finance department wants to keep track and know, do they have the sufficient cash to pay? Management, Pepsi Cola product line is most profitable. marketing people, human resource people, all managers within a business require accounting information to answer their questions. People who are outside the business are called external users to the business. Now, they would be investors, people who put money in the business, who bought shares in the company. They need accounting information to see how well the company is doing. Creditors. Now, a creditor is somebody who supplies goods to a company. Okay? Yeah, they put in inventory. You understand what I'm saying? Or they lend money to the company. They're the bank. Okay? And therefore, they are called creditors. And they need to know how well the business is doing because the business owes them money. And business is basically financed by investors and creditors. Now, also, just as a side thing, we've had problems with accounting in the past 20 years. You've never heard of Enron, have you? They're gone. The guys who ran Enron are actually in jail. They're still in jail 20 years later. AIG, you know that from football, right?
What?
No, AIG isn't one of the football teams have AIG on it? English Premier League? No? Maybe that's an old picture. Anyway, what happened is they lied on their financial statements. And because they lied, people invested money in a company. And the company went under, went bankrupt. And so all kinds of people lost money. So now a big thing in accounting is ethical behavior. So I mentioned that because we just don't do accounting. When we're doing accounting and presenting data, we must be ethical. We must be telling the truth. We cannot mislead because people use that accounting information to buy shares in the company or to lend money to the company or supply the company. So that's why we're talking about that. All right, any questions? Okay, now, when you think about a business, I'm talking business in general now, and I'm talking the activity that business performs. The activities fall into three areas. Now, probably the biggest area is operating activities. Operating activities simply means the business buys in goods or supplies and uses them in a way to sell or create a product for their customer. And so buying and selling is what we call operating activities. And you see that that activity is performed hundreds of times a day, every time a company's making a sale. That is operating activity. But there's also financing activity. Financing activity, the business needs money, flus, to work. Always needs flus. It's the lifeblood of the organization. And they get it by either selling shares and bring money in, or going to the bank and borrowing money. All right? So those are financing activities. Now, the business then takes the money, the flus, and invests it in equipment to produce something, or the equipment to keep the business going. So there's investing activities, okay? And the accounting information system we're going to learn keeps track of all of these three activities. So now we're going to learn some language that we're going to use all the time. And we're going to start with borrowing money. One primary source of funds, the word fund means money, okay, is borrowing the money. When you borrow, when a corporation borrows, and I'm talking corporation, but I'm talking sole proprietor partnership. When a business organization borrows money, that is referred to as a debt. You have a debt if you owe money to somebody. You are indebted. Indebted means you're in debt with that person. If you lent me 100 dirhams, then I owe you 100 dirhams. Okay? The fact that I owe there 100 dirhams, that is also called a liability. And that's where the personal liability comes. So a liability, and keep in mind, I told you last class, this is old Italian. These words come from 15th century Italian, because it was that monk that devised this system 500 years ago. And therefore, a liability and the word debt come from way back then. But I want you to understand now, if you owe somebody, you have a liability to pay, okay? If I owe you, I have a liability to pay. I have a debt. So there's two parties here. Party of who's owed the money are owed by creditors. So when you lend money to somebody, you become a creditor of that company. So when I say the creditors of ABC company, that's all the people that ABC owes money to, has a liability to pay, because these people are indebted to them. Do you understand the language?
Yes.
Now, you will identify in accounting a liability because it will say payable, most of them. So you have notes payable. Now, when you take finance, you'll get in more into notes. And when you take finance, you get into bonds. But a note payable is simply this. Yara just lent me 100. I'm her creditor, okay? I owe her. I don't pay her. I don't. What can she do to me? Nothing. Except run me over if she sees me on the street or something. But you see, if you lend money to a business, just because you're normal business, you supply the variety store down here with goods, and he doesn't pay you, you can't do anything. You can't take him to court. You got no proof. You got nothing. Your word against him, the law doesn't bother with you. But if I gave Yara a note and I said, I owe Yara 100 dirhams.
Evidence.
Pardon?
Evidence. Evidence that you own.
Now that I give you the note and I sign it and I don't pay. Okay? Now in this country, I think they just changed the laws. If I gave you a check, you know what a check is? And it bounces. You know what I mean by bounces? We'll take it to the bank and the bank says that he has no money. It bounces. What happens in this country? You go to jail. You read in the paper where people were in jail because they bounced checks. Well, you see, a check is like a notes payable. It's a promise to pay you and I didn't pay. So off to jail you go, the same thing. So a note payable is that, and word is payable. A bond, that's a financing thing, and that would be later. Bonds are something you'll learn in finance, but they're bonds payable. When you say the word payable, they mean liabilities, mean debt. Now, the other way I can bring money into a corporation It is by issuing shares. I told you when you form the corporation, and I did this in Canada. I formed a family corporation and they gave me the right to issue 1 million shares. Well, I didn't issue. I issued one to my wife, one to my kids, so like that, so that if I get all of that. So that's common shares, common stock. That's how you get money into a company. You sell shares. And when you sell shares, you are purchasing, when you buy shares, you're purchasing what's called a common stock. That's the word for share, common stock. Stock is another word for share. When you hear share, you hear stock, it's the same thing. Now, you own a piece of this corporation, and the corporation is profitable. It's making money. Now, the money belongs to the corporation, but the corporation then, to transfer the money to the shareholders, they call that a dividend. So the corporation will declare a dividend. And the dividend is going to be for every share, I'm going to pay 10 dirhams. So if you own 30 shares, you're going to get 300 dirhams as dividend. Okay? So when a corporation pays back the shareholders, the term we use in business is dividend. That is a dividend. Okay. So that's financing. Investing activities. Now, the corporation needs to invest in equipment, computers, maybe trucks and vehicles, and things of that nature. What those are called are assets. And there you go, the old Latin term, asset. In modern day language, another term is resources. These are assets, are resources that the company owns. They own it. They're going to use it to make money. So you see, a company uses up assets, uses that truck, uses that computer. For how long? 2, 3 years. Well, you see, they're using up those assets. Now, they could be computers, delivery trucks, furniture, buildings. You can have an asset when you own shares of another corporation, another company. Okay, so the term assets, you must become very familiar with. Now, when I was talking about sole proprietor, what I meant was the assets of the business are the assets of the owner. The corporation, the assets of the business are not the assets of the owner. They are the assets of the business, because the business is a separate legal entity. Okay, so there's another word. Now, operating activity. Every business is in business to generate revenue. Revenue is what the business earns. That's the definition. That's the only definition of revenue. Many people say, oh, revenue is profit. No. Revenue is flus. No. Revenue is what you earn. Okay? Sometimes, when you provide the service or product, you get money. So revenue in that case is it. But sometimes, the person's going to pay you later. That too is revenue. Because revenue is what I earned. And I did the job, but I'm going to be paid next week. I still earned revenue. You understand that? A lot of people are confuse this term revenue. Revenue is what the business earns. It's not profit. It could be flus, but it may not be. What is an accounts receivable? Well, that is an IOU. That means I did the job for you. Okay. I earned revenue. You're going to owe me. I call that, I have an account with you, and I'm going to receive that money later. So we call it accounts receivable. Okay? So whenever I earn revenue as a company, one of two things happen. I get cash or I get an accounts receivable. The accounts receivable, think of it as an IOU. I'll pay you later. If they don't pay, I can't take them to court either. Again, same thing. But revenues are generated. The amounts earned from the sale of a product or a service or other service. The accounts we're going to use in accounting are called simply sales revenue or service revenue or interest revenue. Okay. Inventory. A company buys in inventory. You know what inventory is? Look at Carrefour. They have all kinds of inventory in there. Inventory is what the company's brought in to resell to you. That's an asset. Okay? Now, they may have paid for it, that's fine, or they may owe that supplier, and that's a debt or a liability. So, inventory is an asset that consists of goods available for sale. Accounts receivable are the right to receive money from a customer in the future. Now, in operations, I need to spend money to make money. So I'm earning revenue, but I also have to pay rent. I have to pay salary. I have to pay AC. I have to pay for the inventory. All of those things are called expenses. And expenses are things that I paid for in order to earn my revenue. Okay? So expenses are the cost of assets consumed. Keep in mind the company bought this computer 3 years ago. Well, I'm using up this computer. It's not going to last forever. I'm using up a third of it every year if it lasts for 3 years. So that is consuming of assets. Depreciation, we will learn that later. So expenses are cost of assets consumed, and all the other expenses like interest, income tax, administration, cost of goods sold, and so on. These terms will become very familiar with you. This is the first time we go around. Liabilities, I already talked about. Liabilities arise mainly from expenses. A supplier supplies me with potato chips in my thing. Okay, I'm going to pay them next month. Well, I have a liability to pay them next month. Adwea turns on the electricity and they're going to bill me every month. I have a liability to pay it. Okay, a Tesselac, same thing. Now, simply put, if revenues are greater than expenses, that, of course, is profit, but we also use, most often we use net income, because you see, we consider revenue as income, expenses as going out. So net income is the amount of revenue come in minus the expenses that I had to pay to earn that revenue. And net loss means I paid more expenses than I did to earn revenue. Any questions? All right, sign up again. You have to become very familiar with different terminology. Okay, ready to go? Okay, see, test your understanding of the words. Borrowing money is an example of a or an Financing activity, investing activity, or operating activity? Very good. It is a financing activity, not an investing activity. Investing means I put money into assets. Financing means I either borrowed money or I sold shares. All right, question 5. Issuing shares of stock in exchange for cash is an example of financing, not investing. You think you're investing in a company, maybe you're confused there. But in business, investing activity of a business is when I purchase assets, trucks, computers, inventory. Okay? If I purchase stock, that's financing. If I sell shares. So again, the language. Question 6. Which activity involved putting the resources, remember assets are resources, of the business into action in order to generate a profit? Yeah, good, you're getting it. Some of you aren't though. What are you still stuck on investing? Yeah, when you purchase assets. Assets, another word for asset, is resources that the company uses to earn profit. Okay? Question 7. Which of the following activities involve collecting the necessary funds to support a business? Come on, you got it?
Yes.
Well, financing. Yeah, become familiar with the language. Ha 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 ha. 8. There are prizes at the end of this, you know. Buying assets needed to operate a business is an example of investing. Yes, you're getting it. You're getting it. All right, more word. Buying assets needed to, oh, I did that twice. Stupid me. Okay, if anybody gets this wrong. Shaker likes that. Okay. Who put financing? All right. Question 10. I hope I didn't repeat that one again. Which activity involves putting resources? Oh, I did. I am repeating these. Okay, good. It's good for reputation. I should have checked that. I thought I did check. Not there are a little too many slides. For some reason, I hit the button twice. Okay, everybody gets this one right. What? What? Come on. 11. A common characteristic possessed by all assets is long life, tangible, or future economic benefits.
What should we put the seven?
Benefit? Something that's going to give me something, benefit. What did you say? Now, I put these up here because of the language, because of, wow! How did everybody get that one right? Very good. An asset is a resource that the business is going to use in order, now I can use the word to generate revenue and earn a profit. Now I can talk to you in the words I'm talking about. An asset, another word for an asset is resource. It's something the business owns that they're going to use. It's a resource. You know what a resource is? What's the resource here in the UAE? Oil, yeah. You see, and the UAE is going to use that oil, and that oil presents future, how do they say, represents future economic benefits. You understand? Okay. So when we talk of business, we're talking business assets, we're talking business resources, we're talking those resources will provide the business with benefits in the future. And think of the UAE and the resource and the major asset the UAE has, besides its people and the leadership, it's oil. All right, number 12, 17. Expenses are incurred to produce assets, to produce liabilities, or to generate revenues.
Which one?
Okay, keep that in mind. Make sure you get. Oh, come on, you don't produce assets, you purchase them. Remember investing activities? No, the answer here is generate revenue. An expense was used up. Used up means consumed. You know what consume means? Eat, you bring in, you consume.
Eatability.
Uses up, you eat lunch, you consumed your lunch. So, expenses are consumed in order to earn revenue. Okay, 13, 17. The cost of assets consumed or services used is known as, come on, everybody should get this one.
Maybe expensive.
What did you say, man? Seems slow here. We had, okay. Yeah, you're getting it. You're getting it. Okay, a few more questions. Debts and obligations are referred to as too many seconds on this one. Okay, assets, law, expenses, law,
Liability.
liabilities. Yeah, good. Any questions? All right. Resources are referred to as, now everybody should get this. You've been through it a number of times. Too many seconds. I leave it 20 seconds. It should have been 10 seconds. Okay, I said stockholders' equity, liabilities, assets, or revenues. Right. Who said stockholders' equity? Okay, not going to win much. When expenses exceed revenue, which of the following is true? Net loss, net income, or assets are increased. Now this is expenses exceed. Exceed means more than revenue. Expenses exceed revenue. Fox News. Biden just probably invaded Ukraine. No, that's a loss. Revenue exceeds expenses, that's a net income. But if the expenses are more than revenue, it's a net loss. Which of the following is not a liability? Unearned service revenue, well, that is a liability. What is not a liability? Accounts payable? Payable. Payable means liability. And lastly, accounts receivable. Now, accounts receivable is that IOU. It's an asset. So it's not a liability. All right, first question. Right up here, which of the following business organization characteristics? Number one, shared control. What organization is that?
Collaboration.
Pardon? Somebody say it? Shared control.
We say
Partnership.
partnership.
Right, very good. Simple to set up, one control. So you just click on these. Right. Good. No. Simple to set up. Corporation's not simple to set up.
So
Yeah, okay. And easy to transfer ownership. All right, now, with each one of these, you click here to see if Mr. Wiley agrees with you. And he does. You got green. If he doesn't agree, he will show you red. All right, you got 5 out of 5. Let's keep going. Question 1 of 10. 2 of 10. These are all definitions. And it's all being recorded, so. What's the first one? I can't see too well back there. All right, cash received from customers. What is that? Yes, operating activity. Cash paid to stockholders, dividends. And we didn't do that one before. Hey, wow, financing, you got it. When I sell shares, that's financing. And when I pay the shareholders back, that's financing. Okay, number 3. C, cash received from issuing new common shares. I sold shares.
Investing.
Not invest.
Financing activity.
Hey, this guy. Listen to him. He has to do something. Okay. Cash paid to suppliers. Oh, what are they giving you there? Operating, right. And cash paid to purchase a new office building. Investing. Okay, good. All right, any questions? Next. Okay, we can go through these pretty quickly. We're not finished, finish at home. All right, again, finish this. Easy to transfer ownership. Hey? Die, I just passed my shares on, so that's a corporation. Okay. Easy to raise funds. That too is a corporation, very good. More ownership, more owner control. Maybe that's partnership. Well, more owner control. That's confusing.
Is that the first one? Well,
Maybe so. Okay. Yeah, sole proprietor. Tax advantages. Well, heck, that could be sole proprietor partnership. That's confusing.
But no, the farm machine and the stove.
Oh, they had both. Okay, good. And lastly, no personal liability. That's why most companies are corporation. Now you understand personal liability, my friend?
Oh, yeah.
Okay. See, it's all about language. Language is business. Good.
This one.
Oh, okay, this one was, you're partially correct. Never mind, move on.
Wait.
Go to 4. So you're not gonna get 50 out of 50, you're gonna get 49, maybe. Okay, next question. Costs incurred for advertising.
Expenses are replacing
A cost incurred to advertise.
Expenses.
Expenses, right. Okay, now over here, what account title?
Advertising expenses.
What they have here, advertising expense. See, simple English. Okay, cash received for services performed.
Revenues.
You're getting it, you're getting it. And you look for an account that says revenues. And because it's service, they didn't sell a product, they sold a service. You use service revenue. If they sold a product, that'll be later, it'll be sales revenue. Okay, number C. Costs incurred for insurance.
Expenses.
Right. And what do we call that?
Insurance.
Simple enough, right? Good. Amount paid to employees.
Expenses.
Yeah. I need employees for me to earn money. And every time I pay for that, that's an expense. And what do I call that? Wage expense. Or salary expense. Okay, next. Cash distributed back to the shareholders.
Dividend.
Right? Okay, you said that?
Dividends.
Dividends. And I want to see what account titles are going to give you. What do they give you? Shareholders equity?
Not.
I'll put non-applicable. It's kind of confusing, that one. I don't know why I put it in there. Cash received in exchange for allowing the use of the company's building.
Revenues.
Okay? Oh, does it mean that we pay cash?
Received.
Cash received, you're right, revenue. And that would be service revenue.
Rent.
Rent revenue, okay. Costs incurred at WIA, utilities is like AC and stuff like that.
Expenses.
Utilities is the word we use a lot for business, it means all the electricity. Okay? You're getting it, you're doing really well. Okay, what do we have? Expenses? Utility expense. Utilities is the word we use in business. Means everything up moving. Okay. Cash to purchase equipment. Not expense.
Also.
Wait a minute. Cash purchase of equipment. Move down, it's gotta be, that's it? Financing activity or investing activity. Oh, I don't know what that one's gonna be.
It shows wrong for expenses.
Try expense, it's not expense. If I purchase equipment, I'm investing in an asset.
Yes.
They didn't have an asset, yes, sir.
Number key, second one.
What do you got an answer for me or you got a problem for me? I want to see what this works out to be. What'd you say? No, it's not gonna be an asset. Okay, forget about it. Move on. You're gonna have one wrong. Okay, cash received from investors.
Revenues.
Okay, that would be, no, received from investors, common stock. They invested in it. Over here, you're going to put, I don't know, not applicable. Something wrong, Mr. Wiley, you're not doing a good job. Hit the answer, of course, we can get this one wrong.
Not applicable.
But not.
Not applicable, okay. Hit it, let's see. You're gonna get red here somewhere. There, that's all. Yeah, it should be dividends, but it says expenses. We don't have any other choice. Assets. All right, move on. Question 5. Look, it's not that I want you to be perfect in all these. I just want you to show the ministry that you worked in all of this spreadsheet. So I want you to have some kind of mark. Sorry. You can't get on or something?
Yes.
You're right. Okay, let's just finish this. Masalana. No homework, nothing. Unless we didn't finish this. Okay. Okay, oh, right. I haven't got into the financial statement yet. Okay, show me the next problem. Okay, indicate which statement. I haven't talked about the statements. Okay, so the first 5 questions deal with what we did today. Tomorrow, when I do financial statements, we'll go back and do those 5 plus more. Okay?
So should we do this tomorrow?
So just stop right now, and we'll do that tomorrow, not tonight.
Next month.
Monday.
Next week. Monday. All right, that's enough for today. Thank you very much. Just let it hang there, yeah. We'll pick it up later. Good work, class.